Kicking off the holiday week, 30 minutes until the start of trading. I'm Matt Miller.
And I'm Vonnie. Quinn stepping in today for Danny Berger. Bloomberg Open Interest starts right now.
Coming up, Netflix strengthens its financing behind the Warner Brothers bid just as Paramount ups the ante. Larry Ellison personally guaranteeing over $40 billion as the takeover fight intensifies. And NVIDIA is said to be eyeing a mid-February AI chip shipment to China pending a sign-off from Beijing. So geopolitics fueling a commodities rally. Oil jumps on a Venezuela risk as gold and silver hit records.
So much going on this holiday shortened trading week. There's 4 days, but there's going to be a lot of trading, plenty of liquidity out there. As you can see, NVIDIA, one stock I'm keeping an eye on, up 1.8%. Maybe we're continuing this rally that we had for the last 2 days of last week. NVIDIA among stocks leading markets higher after a report. It's told Chinese clients it does aim to ship its second most powerful AI chips to China by mid-February.
All right, so obviously that's a stock that we're watching very closely. Also watching Paramount Skydance. It sweetened its offer for Warner Brothers today. Larry Ellison agreeing to personally guarantee $40 billion in equity financing for the proposed $108 billion takeover offer for Warner Brothers.
So let's bring in Bloomberg Tech co-host Caroline Hyde now for more on this story. So Caroline, this is getting really interesting. What I'm curious about is how long can this continue on, given that shareholders aren't voting until the middle of next year?
I mean, this is such a Hollywood drama, and we're living in it blow by blow. Now we're going to get real nitty-gritty details of basically Larry Ellison's wealth, of the trust. He says it's going to be irrevocable. I will not be able to start selling off bits of my assets. Largely, that's in part backed by equity shares of Oracle in and of itself, which is a share price that's been under pressure of late. But basically, he's committing, because that was the vulnerability of their offer. Remember, there is more on the table coming from Paramount in terms of financial money than there is coming from Netflix. But Netflix doesn't want the whole shebang. It doesn't want CNN. It doesn't want the cable networks. It just wants the streaming in the studios. And so from their part, all along, we've seen Warner Brothers say Netflix's offer is better, but also because the clarity of the financing. The clarity of the financing was pretty clear from Netflix. Now they're also managing to piece together what long-term financing looks like. They had bridge loans in place, BNP Paribas, HSBC, some of the banks around that. Now they've already got a revolving credit facility in place for $5 billion. They got two $10 billion loans on track. Therefore, we know that they're going to be syndicating, looking back to syndicate about $34 billion worth. You then look over to what Paramount's been doing, and they've basically been saying, my dad's really rich, and he's going to be able to afford this. But then they were like, but what are the details of his wealth, and how set in stone is that? Oh, and why have you been leaning on maybe Tencent at one point? Remember the Middle Eastern investors? At one point, it was even Jared Kushner as well, who's then since dropped out. So all of this was just more anxiety around the real financing power of Paramount Skydance. And now with this, they're trying to say, look, we are good for it. Up to $40 billion worth. It's going to be guaranteed by Larry Ellison himself, one of the wealthiest people in the world. But also, they're saying if this deal doesn't get done, we'll give you even more money, $5.8 billion if it gets cancelled.
So, but other than upping essentially the breakup fee and matching the breakup fee that Netflix has already offered, they haven't increased the payout to shareholders. So that's still to come, right? Sweetening the bid.
Exactly. And I think that's what many have felt, is that it's being it all comes down to how much do they value the cable networks at. And seemingly a different price than what David Zaslav thinks he could get if he spins them off. And so all of this comes down to whether or not they're going to up the actual amount. We've heard time and time again on the tech show, people coming in going, don't underestimate the competitive nature of the Ellisons and the willingness they will do to actually bring more money to the table. Maybe this, Vonnie, is the answer to your question, how long does this run? Maybe we do start to get an even more sweetened deal. But as you say, they are extending the tender offer as well out to January 21st, which is a little bit longer than they had. They're going direct to shareholders here. So it's up to the shareholders to decide, how much value do I put on these cable networks?
Yeah, now, does it matter what's getting taken? So if Netflix doesn't want part of it, but, you know, Paramount will take that, does that have to factor in as well?
I guess it does from a regulator's perspective as well. I mean, also the key issue for many is the relationship the Ellisons have with the administration. And some of the reporting out there has been that, you know, it's not been unknown that perhaps the administration would like a new owner for CNN and the like. So maybe they do want to see Paramount Skydance take out that sort of part of the business. But more broadly, I think that when it comes down to monetary value, clearly David Zaslav thinks that there's more money to be got from these cable networks. Remember, for Paramount, the cable networks are actually basically where a lot of the profit was for the business to begin with.
I want to switch topics really to NVIDIA, because for the last few quarters, when the biggest company in the world, the biggest chip maker in the world, has come out with earnings, it always puts a zero in its outlook for China. Yes. And now we know that they actually, or there is reporting, according to Reuters, that they actually are getting ready to ship chips to China.
And boosting up production, maybe as soon as second quarter of 2026. The big issue in the room still there is, what is the government of China going to say? They still haven't got sign-off. It doesn't matter whether Jensen wants to get the H200s back up and running. If China's not going to be able to actually buy them because the government's going to limit them, that is the problem. But these are really sophisticated chips. They're far more powerful than the ones that China is currently getting access to, even though they don't want the H20s. Maybe we will see some work around the H200s. It's interesting as to how this all just fits in geopolitically as well. Maybe we're getting near an actual sign-off for a TikTok deal. All of this is small incremental steps, and a big part of the relationship between US and China is China's access to the most sophisticated semiconductors. So we've got to see whether Beijing does indeed come in and say, yeah, you can start your production, and actually maybe we will buy them.
Yeah, it's a little bit of theatricality as well, right? And as you say, maybe a tiny bit of leverage. You know, do we change our mind on these NVIDIA chips, even though we want them secretly, because that way, you know, maybe the TikTok deal will get done faster, or what have you. Caroline, how much incremental revenue would this actually be for NVIDIA? Would it be enough to make analysts maybe revise price targets or to bring in new investors?
Yes. They have talked about the total addressable market being tens of billions of dollars. Up to 50 billion is what they could immediately start accessing if they're allowed to start tapping. China was their second biggest market before they were shut out. This is significant for the analysts, but because we've seen time and time again, Jensen B. Conservative said, I'm factoring in zero in terms of my sales. Analysts haven't been able to upgrade their absolute outlook in terms of price targets or indeed revenue throws. So I think this would be a significant growth trajectory for NVIDIA if they're able to turn the tap back on.
Well, they're certainly expecting to, according to Reuters. Caroline, thank you so much. That is Bloomberg Tech co-host Caroline Hyde. Commodities surging this morning as well. Oil prices jumping after the U.S. Coast Guard pursued a third oil tanker off the coast of Venezuela as part of President Trump administration's crackdown on the Maduro regime. The escalating geopolitical tensions also sending gold and silver prices to records. Bloomberg Intelligence senior commodity strategist Mike McGlone joins us now from the Miami Bureau. Silver has been outpacing gold all year, or for most of the year anyway, Mike. What has this particular trade got to do with? It's not just geopolitical tensions, is it?
No, it's about everything. The key thing, inklings I have in gold and silver now, is the old mantra, you're supposed to be selling when they're yelling. These markets are so far stretched above most moving average, say 60-month moving average, that you can only compare them to 1979-80. Now, they went up much higher, but gold's peak that period, $800, bottomed around $200 in 2000 or so, and it took decades to get above those levels. Same's in silver. The significance is what's happening this year is all these markets going up, with crude oil going down, is a significant global recessionary trajectory. The key question is, does that continue to next year? So I'm really worried that precious metals are getting way too expensive. Typically, investors at these levels have to wait decades to recoup their money, even though it can go up a little higher. And crude oil is getting cheap, but it's bouncing on reasons that most prudent traders are looking for reasons to sell at higher levels.
Is crude oil going to continue getting cheap as we blockade Venezuela? I know it's not a huge contributor to the global market, but it's something, right?
It's something, maybe 500,000 barrels a day, all of it's going to China. So, Matt, it's really insignificant. But if there's a regime change in Venezuela with some of the world's largest crude oil reserves, you know what that means. More supply, Trump's mantra goes the right way, and it's already happening. So crude oil right now, which is around $57 a barrel, was the average price in 2019. We've gone back to that level. It's basically the break-even cost, and typically you have to get below those break-even costs for an enduring period to put in the bottom. Same things happen with natural gas and the average gasoline price. They're all heading lower. Now, they're supposed to bounce. The question is, are they enduring? I think the bounces will meet selling as we see this major thing. And the number one factor for all these commodities to go higher is the U.S. stock market has to keep going up, and volatility is very low there.
All right, Mike, thanks very much. Bloomberg Intelligence senior commodity strategist Mike McGlone there talking to us about the new highs that we're hitting in precious metals, the drop in oil. Joe in the control room also pulling up MapGo, which shows you the blockade around Venezuela, but also shows you the wealth of oil tankers on the sea right now. There's just so much oil floating on the water. that I don't know how much higher you can expect to see prices go. In terms of futures, you saw the green on the screen there. We do have S&P futures rising 0.5%, maybe a little bit of a Santa Claus rally kicking off here, 0.75% on the NASDAQ, and the small caps gaining as well.
And let's look at some other movers on our radar as well, Matt. A group of private equity firms led by Permira and Warburg Pincus in advanced talks to acquire Clearwater Analytics in a more than $8 billion deal.
Cintas has submitted another offer to acquire UniFirst for $275 a share in cash, including a $350 million, I guess we're calling this a reverse termination fee now. This is the breakup fee.
And Harbour Energy agreed to acquire LLOG Exploration for $3.2 billion, marking the UK company's entry into the Gulf. And these are not small deals, Matt.
Now, coming up, Wall Street bulls are charging into 2026, causing some concern for other investors. But mostly, they're just all bulls. We'll talk about that next. This is Open Interest. Let's get now to high interest. Look at what's making headlines around the world. Democrats are threatening legal action after the Justice Department missed a deadline to release all of the Jeffrey Epstein files. Lawmakers say the DOJ is violating a bipartisan law by slow-rolling, heavily redacted files, calling it a cover-up. The department says more documents are coming, citing volume, victim protections, and court limits. The partial release has reignited political fallout ahead of the midterms. And nearly a year in, New York City's congestion pricing experiment is delivering results. Traffic in Manhattan's toll zone is down 11%. Pollution is falling, and the MTA is on track to beat its $500 million revenue goal. Fears of economic harm have not materialized. Foot traffic, storefront occupancy, and sales tax revenue are all up, making the program a potential model for other U.S. cities. And Tesla's electric doors are raising new safety alarms. Bloomberg has found at least 15 deaths in the U.S. over the past decade where people were trapped in burning Teslas because doors wouldn't open, with more than half of the deaths occurring since late 2024. Regulators are now investigating, and Tesla says it's working on redesigns and new automatic unlocking features. And just in, Trian and General Catalyst are out to buy Janus Henderson for $49 a share. This Janus deal, according to Trian and General Catalyst, expected to close mid-2026. Trian and General Catalyst, this bid that they're submitting together values Janus Henderson at about $7.4 billion. Vonnie.
Yeah, and don't forget, the activist investor Nelson Pelson Trian has been involved. It's been an investor in Janus since the late part of 2020. So this is really interesting. The investor group is also including the Qatari investment group as well. So let's talk a little bit more about this now with Bloomberg Markets Live managing editor Christine Aquino, as well as the market at large. But this is a massive deal. General Catalyst and Trian taking Janus Henderson, an asset manager, private. I mean, do they need access to the funds that, you know, Janus Henderson would have in reserve?
Yeah, I mean, I can imagine, Vonnie, that the private equity group is very much interested in the funds under management by Janus Henderson. And it really just speaks to kind of the broader evolving just the landscape of finance, right? We have seen a lot more institutional investors, the likes of pension funds, for instance, playing with the idea of diving into private equity, where, of course, there's a lot more reward potentially, but also potentially a lot more risk, just because of the fact that the companies involved in this space very differently structured from publicly traded companies. But, you know, there's a wall of money out there, right? Like waiting to be put to work, especially now that we're kind of potentially seeing a shift in the interest rate landscape as well. And so, yeah, you have to imagine that, you know, the interest in fund assets under management with Janus, very much of interest among these types of companies, private equity. And conversely, the investors with Janus as well, potentially interested in those assets as well.
Yeah.
Of course, there is a lot more M&A happening, a lot more IPOs. Animal spirits are up, and investors, strategists are bullish, right? We have a story on the Bloomberg showing that there's really tightly clustered targets all headed in the same direction.
Absolutely, Matt. And really to be expected, right? Because it really has not paid off to be a bear in really the past decade when it comes to the equity market. Over the past decade, we've seen the S&P 500 deliver annual gains for, 7 out of the last 10 years. And the years that it did deliver annual declines, it was really more because of external shocks rather than whatever's going on with the market exclusively. And, very interesting, actually, the forecasts we're looking for around an 11% gain for the S&P 500, which is half of what we've seen over the last 2 years. So you could argue, actually, maybe they are bullish, but a little less so than the last couple of years.
But it's a little bit terrifying, though, right, Christine? Because, all of those fragilities that have been out there for the last several months are still there. Very few of them have been resolved. So the tariff uncertainty is still there. We don't know what the SCOTUS decision is going to be. The effects of the One Big Beautiful Bill, we don't know what that's going to be next year. The data is a little distorted, if not stale completely. So how can analysts be so sure?
Well, I mean, Vonnie, again, right, like just kind of the expectation for that much of a gain, which is, when you put into context of the broader S&P 500 moves that we've seen over the last few years, it is a little bit less, right? And so the bullishness has been tempered, and you're absolutely right. So many risk events here, and I think that is what kind of is causing a little bit of that more subdued outlook. I mean, when it comes to the Supreme Court decision on tariffs, very much a focal point for markets next year. We have seen, though, from the latest Markets Pulse survey that my team does, that people are optimistic about the potential for the removal of those tariffs. So the expectation is that the S&P 500 is more likely to go higher if we do see, in fact, the removal of those tariffs, probably just because of an improvement to risk sentiment.
Hey, what's the MLive team have planned for the holiday? How do you staff up through, well, I guess President Trump has wanted to make Christmas Eve and Boxing Day holidays as well.
Don't worry, Matt, we're going to be around. I'm going to be around personally, keeping the lights on. But no, I mean, yeah, I think, these days actually are the most dangerous in some ways,
right,
when it comes to the market movements. I mean, a few years ago, I remember, what was it? December 24th was the biggest day for equity volatility a few years back. And so we're coming to that point in time where volatility is low. You have much fewer players. And that is when there is greatest potential for markets to gyrate wildly, especially if we have any sort of unexpected risk that's playing out. So don't worry about it. We're going to be around. Call on us if you need anything.
And the Nasdaq wants to go to 23 hours a day trading, right?
Yeah, 23 and 5, yeah.
All right, Christine, thank you so much. That is Bloomberg's Christine Aquino. Coming up, Morgan Stanley's Andrew Slimmon says he's seeing late cycle behavior in markets, but the question is whether the bull market euphoria lasts months or years. This is Bloomberg Open Interest.
I don't see a recession in the near term, in part because we are adjusting our policy rate by lowering it, which is appropriate. My view, as I've described, is that a variety of shocks that hit the economy, including changes to the population growth rate due to changes in the border policy, have pushed what we call the neutral rate down, and that policy needs to adjust downward to reflect that downward shift in neutral. If we don't adjust policy down, then I think that we do run risks of rising recessions.
Fed Governor Stephen Miron on Bloomberg Surveillance there. Well, joining us now is Morgan Stanley Senior Portfolio Manager Andrew Slimmon. So in spite of what Governor Miron says, Andrew, what do we get next year in terms of rates? Because it would appear to most people that central banks around the world are pivoting and that maybe some of them are even done.
I don't think Andrew, can you hear us? Can you hear me?
I can hear you now. Yeah, great.
All right. So, sorry, we lost touch with you for a second there. We were just listening to Stephen Miron. Understandably, he thinks the neutral rate is far lower than where we are now, but that the economy is hot. It's the hottest economy in the world, right? Do you think that the Fed needs to cut more in order for us to get the double-digit earnings most of Wall Street is expecting?
No, I don't. Look, and I'm a portfolio manager. I'm talking to companies all the time. I don't sense weakness out there. I don't think earnings growth, which should be very strong next year, 14% earnings growth, is predicated on Fed cutting.
That is real strength.
But
14%
that presents a
again.
problem, though, right, Andrew? Because what if the Fed does cut? I mean, there are two penciled in, and you've got, you know, doves like Myron wanting even more than that.
Yeah, I mean, look, Ronnie, the number one rule of investing is don't fight the Fed. I mean, it's on page 1 of the investment handbook. It is one of the reasons to be optimistic on 2026 for equities.
So, but are you worried that this economy then runs too hot, that we get inflation that's too high, that we get valuations that are also too high, or do you think
100%.
something keeps in check?
100%, Matt. You're dead on right. You combine two risks there. One is the speculative elements come back in the market, which is what we saw earlier until really a washout in November, and that inflates a bubble, and then bad news comes along, maybe bad news we don't know about, and that causes a correction. And then secondly is what you said is inflation comes back and the Fed has to pivot. I think that's a real risk. I'm not sure that's a risk in 2026, but I think that's definitely a risk.
Andrew, what if we start seeing negative payroll prints, and that's not out of the question?
100%. However, I would point out, Vonnie, that in the late 90s, the S&P, doubled before the dot-com blow-up, and we had multiple payroll negative prints. When you have big technological advancements, job growth stalls. That's not that unusual. So I don't think that will derail the stock market.
All right, Andrew, we're going to keep you with us. Opening bells on the other side of this break, and then more with Andrew Slimmon there from Morgan Stanley. Quick check on futures kicking off this Christmas week, looking at gains on the S&P, 0.5%, 0.8% for NASDAQ futures, and the small caps gaining as well as we hit record highs on gold and silver, and we see oil recover a bit from the tumble it's taken lately. Stay with us. This is Bloomberg Open Interest. We are moments away from the start of trading on this Monday, kicking off the shortened Christmas trading week. If you're looking for volatility, you may find it in lighter trading today. S&P futures up 0.5%. Actually, futures haven't moved much at all. NASDAQ futures up 0.8% as well. You hear the opening bell. If you look at the New York Stock Exchange, we see Michael Rafferty from Direction with his team ringing the opening bell. They have a bunch of leverage and inverse ETFs that have been very popular. And this reminds me that ETF IQ is on today. It's Monday. It's a show I used to anchor, but Scarlett Fu now is there with Eric Balchunas and Katie Greifeld. Looking forward to what they have coming up today at noon. If you look at the NASDAQ, you've got Byrna, less lethal, ringing the opening bell. They sell essentially guns that don't kill people. They're like hard plastic pellets that are excruciatingly painful, or chemicals like tear gas that incapacitate you for 30 or 45 minutes. They're in a good mood. The stock has not done well at all.
You got way too excited about those explanations, can I just say, Matt?
I spent too much time on the website today, and it's a fascinating,
CO2
I guess,
pellets, yeah.
Technology is one word for it, but the stock has done poorly. It's down like 40% this year, and no matter what time period, I wasn't cherry picking. It's just been a bad stock for investors.
You're in pellet picking. All right, that's Byrna. I'm keeping an eye on Janus Henderson for one. Trian and Catalyst, General Catalyst that is, will buy Janus Henderson for $49 per share. CEO Ali Dibaj will remain in his role. The deal expected to close by mid-2026.
And Paramount Skydance has, in some ways, sweetened its offer for Warner Brothers today. Larry Ellison has agreed to personally guarantee more than $40 billion in equity financing for the proposed $108 billion offer for Warner Brothers. They've agreed to raise their breakup fee to that of Netflix, $5.8 billion, but they haven't increased the bid, really. So it'll be interesting to see if that kicks off. Just one piece of the huge M&A picture on this Monday morning. Let's bring back Morgan Stanley Senior Portfolio Manager Andrew Slimmon. Andrew, the animal spirits are alive and well at the end of 2025. A ton of M&A, a lot of IPOs. Does this continue solidly into 2026?
Well, Matt, what's fascinating is normally the big winners, the animal spirit stocks, they do great in November and into the first half of December, and then they peter out as all the tax loss selling and the losers gets washed away and they start to rally. But that's not what's happening this year. The momentum stocks got clocked in November, and you can see now they're coming back, roaring back, and the losers of the year, the defensive stocks that had caught a bid earlier in November, they're fading. So yeah, I think you're getting a return of kind of the more speculative elements late in the year. That's pretty bullish.
Andrew, Micron's earnings, was it enough? I mean, obviously it was enough to turn market sentiment for the moment, but was it enough to change the whole narrative around the AI bubble and how, circular financing might be a problem and so on?
Yeah, I mean, Vonnie, so what's interesting is when companies that have to do with semiconductors or AI, when they report their numbers, they all say the same thing, which is demand's off the chart. So when we focus on fundamentals, I think the stocks do well. It leads to the group doing well. But in between those earnings season, that's when the anxiety about a bubble or too much spending or circular investments, that's when the group trades off. The good news here is the more people worry about a bubble, the less likely a bubble exists because it keeps valuations down. And most of these stocks trade at very reasonable valuations, all the very big stocks. So I think it's a good thing.
Why is that? I was looking at the GICS sector groups on the S&P and sorting them by market cap and by price earnings multiples and market cap weighting price earnings multiples didn't change the weirdness that I saw, which was that energy and utilities are cheap right now. Even the hyperscalers and IT are like middle of the pack in terms of how expensive they are for next year's estimated earnings. I would think in an AI bubble, those groups would be the most expensive, but they're not.
100%. You nailed it. Look, the S&P forward PE on the tech sector is lower today than it was at the beginning of the year. And so bubbles include excessive valuation. Anyone that says we're in a bubble, I say, well, you must have really thought that last year when the valuation was higher. The answer is that the E has done very, very well. The dangers of looking at PEs is people put too much emphasis on the estimate, the denominator, and with energy, it's lower. So it looks cheap, except energy's done poorly because it turned out that energy prices have come down more than people expected.
Andrew, does it give you pause at all to see gold above $4,400? And then you also have the likes of silver at records, platinum above $2,000, copper nearly at $12,000 a ton?
Yeah, I mean, that worries me. But I will tell you this, Vonnie, look, I've been doing this a long time. I go around, I speak to clients and investors. In the last 15 years, I would say when I give presentations and then people raise their hand in the audience, the first question I have is, I'm worried about the stock market because of the deficit or the dollar. And if you'd pulled your money out 15 years ago because of the deficit, it would have been a real problem. My point is, I don't know how to qualify that other than the fact that it's not about the weakness in the dollar, it's a weakness in, fiat currencies. And I think it makes sense to have a portion of your investments in hard currencies that aren't dependent on politicians being fiscally disciplined, which they largely are not. But at the end of the day, I guess the losers are fixed income investors who are, currency denominated.
Yeah, it's the dollar. We've been calling for the demise of the dollar for so long, and regardless of the profligate spending in Washington with no guardrails to speak of, it hasn't fallen more than 10%, really 12% max from the peak. Do you see that drop continuing, or is it?
Yeah, I mean, I think the dollar has been weaker. That helps foreign markets, especially emerging markets. But the key assumption you made there is that other politicians in other countries are going to be more responsible, and therefore their currencies will do better versus the dollar. I question that. So that's the point of why gold, I think one of the reasons it's going up is that all currencies are depreciating. Maybe our dollars come down a little bit more versus others, But I wouldn't make a big bet against the dollar. I don't see it going up with all the liquidity we have coming in next year, and that will bode well for other parts of the world, especially emerging markets.
So, Andrew, what do you say to somebody who's taken some nice profits this year, has money to put to work into the new year? Where should they put it to work?
Well, I mean, first of all, we had a big downdraft in April, and that created a wonderful opportunity. I know that in the midterm year, you tend to get a downdraft, and people will say it's the end of the cycle or excessive or some point. And I'll be counseling people again to take advantage of that. We will get a correction at some point next year for reasons we don't necessarily know about. But I suspect we'll start the year relatively strong, and it will pull money in, and then we'll get a downdraft, and people will panic and want to sell. And that's just the opposite of what you should do.
All right, Andrew. Hope everybody's listening out there. That is Morgan Stanley's Andrew Slimmon.
Can I also add, Merry Christmas, Andrew. And thank you so much for all the time that you spent with us this year. Hopefully we get you back on Open Interest soon. Again, Andrew Slimmon there from Morgan Stanley. Let's get a check on what's going on in the markets right now. We are only about 10 minutes into the session, but looking at gains about 0.4%. So we're up about 30 points right now on the S&P 500. This is the move screen, I think, the most dynamic way to look at stocks on the Bloomberg or at indexes on the Bloomberg. You can see the breadth is very positive to the upside. 370 stocks gaining, only 132 down. And the NVIDIA story, Reuters reporting earlier that they're going to be shipping more chips to China than previously expected, helping that stock up 1.2%. Not a huge jump, but it adds 6 points to the S&P 500. Tesla also doing well on a story that the pay package, believe it or not, Elon Musk's massive pay package before he had a really massive pay package has been okayed in Delaware by a high court there. Meta and Palantir up as well. Apple, Microsoft, Google, Broadcom, Netflix, all to the downside. So this chunk of the Mag 7, if you'll, I guess, grade 8 if you want to include Broadcom, is a weight on the index today. So even though breadth is overwhelmingly to the upside, watch this space because it could drag us down. Here are the GICs. These are the S&P 500 industry groups that we watch. Energy is the biggest gainer on the day. And as I said, it's also one of the cheapest industry groups. Actually, I think the cheapest if you look at forward PEs. And, Vonnie, this is an interesting point because I was listening to Lori Calvasina earlier on Bloomberg Radio, and she was saying she's just traveled through Europe and she's had client meetings across the U.S. People want cheap right now, and that's definitely what energy is.
Not easy to find it in markets like this, that's for sure, Matt. Coming up, it's not just stocks climbing. Oil happens to be rebounding today amid geopolitical tensions in Venezuela, Ukraine, and the Middle East. This is Bloomberg Open Interest. Time now for our top calls. Some of the analyst action in focus this morning. First up, Clearwater Analytics. It is getting an downgrade, actually, at Oppenheimer after it agreed to be acquired by Permira and Warburg Pincus, and that's a group of investors that are leading that. Oppenheimer saying the deal likely caps any further upside and leaves little chance of a competing bid, given the buyer's scale and financial strength. Next up, Loop Capital upgrading Ollie's bargain outlet to buy, saying investors are underestimating its sales growth. The firm says rising consumables driving more traffic and highlighting the company's strong positioning as shoppers trade down this holiday season. And finally, Citi is putting Marvell Technology on a positive catalyst watch ahead of CES, saying meetings with management strengthened confidence that AI data centers will drive accelerating sales growth into 2026 and beyond. The firm expects CES to showcase stronger networking adoption, helping Marvell win next-gen AI business. Matt.
I'm excited for CES. It's just a couple weeks away, which is, by the way, usually that's a technology show, right? It's turned into a car show now.
Yes.
In Vegas. So very cool stuff for sure going to be coming up. Optimism for a year-end rally in equities is growing after dip buyers late last week supported a rebound in U.S. stocks. We're also seeing a jump in commodities with gold and silver touching all-time highs. Not sure if that's optimism. While oil rebounds on geopolitical tensions, that definitely is not optimism. Let's discuss it all with Bloomberg News macro strategist Michael Ball. It just seems like everybody wants a Santa Claus rally. Am I right in feeling that?
Yeah, and look, we got through all the catalysts at the year end, which was sort of this wonky data, which we didn't put a lot of credence into after the Fed basically said they would be ignoring it. Once we got above 6,800 on SPX, we sort of cleared this area now that's much more positive. And as vol comes down, sort of systematic buying increases, we're just melting up. And there's not much to really stop that unless we get something unforeseen, which obviously is always possible.
And we had triple witching Friday and so on, so
Right.
all that's out of the way, right? Is volume, any way decent at all?
Yeah, I mean, it's where you would expect it for the holidays. Triple witching was a big deal. We had a lot of positioning around that 6,800, 67 on the SPX. And of course, I'm using the S&P as our proxy for risk in the equity market. But the Russell continues to outperform too, which shows this rotation trade on hopes of a better first half growth pulse is still there. But also AI came back. Some of the Gemini news last week, as well as some of the clarity in Oracle and what was going on with these data centers, helped kind of alleviate the concerns specific to that pocket. And as we know, with the market cap being so heavy, it's a big part of the tape.
What do you make of the run-up in gold has been insane to watch. Just, relative to previous moves, we have never seen like anything this steep since the 70s, as we were hearing earlier from McGlone. Yeah, like a building story all year, right? Which is really now taken off as sort of speculative fervor, because obviously we know we have the central bank buying, we know we have having the gold inflows. Up 70% in 1 year is just nutso. And silver even more. So again, there was a fundamental story, and I actually pushed back on the debasement. I think that's part of it, but the real flows were there, both from retail and institutional buying, and now you have the stable coin guys and some of the treasury departments and corporate buying gold. But if I look at the option market, and this is what really scares me, we're at 100% for call skew for some of this stuff on GLD and SLV. There's options are just basically telling you there's no one really left to buy these. It's so expensive to take upside position that you really have to have this miraculous story come in to get paid out.
And then there's the Federal Reserve, right? There's 2 cuts priced in for next year, but literally anything could happen because we don't have data, we don't have the name of the next Fed chair, and those dots could just go anywhere next year, and that could totally upend this market too.
Absolutely, and I think it's going to be interesting in January when we start to get the real data again. But I will point out that gold and silver weren't really moving around when we started talking about Warsh and Waller more, showing they decoupled from this kind of Fed independence fear, which I thought was very telling in a lot of ways, because it made sense when we were talking about Hassett and thinking about, well, maybe there'll be more cuts and it'll be a deeper cutting cycle as we think about our star falling further. But that's not the case right now. There's kind of an even odds now, Hassett still being a favorite, but when you look at Warsh and Waller and combining them, it should be a more neutral take on the Fed, and that shouldn't be so pro-gold. But yet here we are, new highs again today.
I thought it was interesting to see Hammack out, I think in the Wall Street Journal, saying essentially she thinks that we're already below Maybe we're already below neutral, and that the labor market isn't as weak as people say. By the way, I have these long conversations with ChatGPT about markets, and the AI bot tells me that the
Just call me,
bond vigilantes are back. But I'm looking at a 10-year Treasury right now, still 4.16. I'm looking at 2s, 10s, still 66 basis points. I mean, it doesn't really feel like. I say this because you bring up, the
Fed worries,
the Fed concerns and guardrails and debasement and gold. Like, it doesn't feel like the market cares at all about Fed independence.
Yeah, we're steeper marginally over the last few weeks, but certainly not at some kind of worrying level, or the velocity is what I'm really watching. We've stayed in these ranges as far as levels for yields, but also the curve itself hasn't materially decoupled from anything that we've seen recently. So yeah, it's just not there. And I don't know why that is in a lot of ways, because to your point, there's a lot of cross narratives that should be pushing that higher. And it's a very popular trade, but maybe because it's year end, people are like holding off on that.
All right, well, we'll see what happens to inflation and inflation expectations next year, and if that changes anything. Michael, thank you so much. That is Bloomberg's Michael Ball.
I will start calling you now, Vonnie.
Please do.
Instead of talking to ChatGPT about it on my commute home.
Just don't bring your burner weapon.
No, I will not bring a non-lethal weapon from Berna. We will be right back with more on this holiday rally. This is Bloomberg. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on stocks. Rallying on this Monday morning. We're looking at S&P 500 up to 68.65, so up 0.5% and just about 50 points away from an all-time record. Actually, 40 points away from that. NASDAQ right now up 0.6% at 25,500. Taking a look at what's going on with NVIDIA, it often it moves the direction of these indexes. Right now, it's up 1.2% on a report from Reuters that it is delivering chips to China, or preparing that, as well as expanded production. Micron also up more than 3% after a fantastic earnings report, or an earnings report at least that investors considered fantastic last week. It continues its rally higher. Paramount up 5.5% after Larry Ellison coming out and saying he will back the Paramount bid, at least $40 billion, the equity portion of it, with his own private wealth, and that they'll raise their breakup fee to $5.8 billion. Janus Henderson on a buyout offer from Trian and General Catalyst. Chevron right now up 1.7%. Oil is up this morning as the U.S., I guess, continues to track and hunt down a third tanker from Venezuela. And then Clearwater Analytics. We've been talking about this one all morning. There's a deal here, Vonnie, that's driving the shares right now higher 8%.
Yeah, exactly. And we'll get more on it, Matt. It's an $8.4 billion deal in total. Clearwater being taken private. Let's welcome in Bloomberg Deals editor Fareed Salool. This is a really circular story because these same people brought Clearwater public just a few years ago, right? Fareed, explain to us what happened.
Yes, right. Well, first of all, thank you for having me. It's weird to be in the penultimate week of 2025 and still talking about multi-billion-dollar M&A, but here we are, and that's testament to the year we've had. You're quite right. These companies know this company well. They were invested in it, I think, in about 2000. They helped take it public in 2021, and now they're back in the game, taking it private again. I will defer to portfolio managers at Warburg and Permira on the rationale, but from the outside, this looks like a kind of classic case of a private equity firm going after a software as a service provider. Private equity loves those companies. They generate stable, recurring revenue from loyal clients. And in the years since they've gone public, they've been moving more into AI, which of course is something we know that, it's a game everyone wants to be involved in right now. And so Permira and Warburg are back for another crack.
I just got to ask about M&A in general. You have a lot of experience covering deals, and I know that there are certain times of the year, Labor Day weekend, for example, where M&A reporters have to be like hitting the mattresses, right? All the news is coming in.
Yeah.
Is that not the case over Christmas? Do they give you a break, or do they try and rush deals before year end?
Well, there is usually a bit of a rush, but they also do. They do give us a little bit of time off around the week before Labor Day, like that kind of end of August period, and the end of December, usually quiet periods. That's not been the case this year. It's just been full steam ahead. And yes, so there is sometimes an opportunity to get things done before the end of the year, and this year we're seeing it. Yeah, we're seeing that play out.
So Clearwater went on a buying spree and bought a whole bunch of companies, and sort of it grew itself, right? And now it doesn't just provide back office services, also middle and front office. Does it have competitors? Is this,
Well, I think what's interesting about that buying spree is it's something that they've done since going public. And I think what that has meant is they've taken on a little bit more debt. This has caused some investor concern about that leverage, and the stock has been under pressure because of that, right? That gives them an opportunity, these private equity firms, to come back in and buy it back cheap. Yes, we've also seen an activist investor get into the stock. Starboard's there. It clearly thinks the shares are undervalued, but it remains to be seen whether it's happy with this offer.
Fareed, great having you on the show. I know you're incredibly busy today. Fareed Salool there from our deals team, and there's a lot going on. Coming up, Lori Calvasina of RBC shares her 2026 outlook at the desk. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Vonnie Quinn, stepping in today for Danny Berger. And let's have a look at these markets because we are off our highs, but we are still in the green for the major indices. The Dow up 0.25%, the S&P up 0.5%, the Nasdaq up 0.2%. This would mark 7 months of gains for the S&P 500 if we do continue this pattern through the rest of the year, obviously. But it is all of the Mag 7 that are doing well. It's the chip companies after Micron earnings last week. It's the fact that we don't have to worry about the Fed for a little while. Plenty of things, positive catalysts.
And my 401k looks fantastic. Coming up, Netflix strengthens the financing behind its Warner Brothers bid just as Paramount ups the ante. Larry Ellison personally guaranteeing over $40 billion as the takeover fight intensifies.
And a look ahead to Washington and the policy backdrop for 2026.
And what if your HSA could pay for your wellness routine? Truemed is betting big on that idea. CEO Justin Mares joins us later this hour. But we begin with the street positioning for 2026. Lori Calvasina, RBC Capital Markets head of U.S. strategy, is upgrading healthcare and communication services, writing in her year-ahead U.S. sector outlook, quote, "Our other S&P 500 sector recommendations are unchanged. We are veering towards valuation opportunities," and she joins us on set to talk about that now. To be honest, I haven't actually looked at my 401k. I just assume that, because the market's up, I'm doing well. If I wanted to go in there and rejigger things, how should I do it for 2026?
So look, what I will tell you is that the portfolio managers I talked to are looking for value, right? And that was sort of the crux of our sector report this morning. And I think there's some debate over where that value lies. I do think there's a general sort of itch to rotate away from the old leadership. Kind of the first wave of the AI beneficiaries, things like industrials are quite expensive. Tech has looked expensive on our work. Not all parts of tech, but the semis space specifically. I think that when I've sat around tables with PMs, we've talked about healthcare, comm services. These seem to be two of the ones that are gathering the most interest. But things like energy are coming up, consumer staples. I will say nobody's really wanted to talk about REITs. Those look interesting on my work from a valuation perspective. But there is
Wait. REITs, first of all, one of my good friends, David Auerbach, he only wants to talk about REITs.
Okay.
Right? Why doesn't anyone else want to talk about them?
I think with REITs, and look, we're market weight this sector. Our analysts have a pretty constructive performance outlook on it. You can't really use a lot of my tools, frankly. Things like earnings revisions don't necessarily work for this. And I do think, maybe the fact that it's a little bit of an outlier methodologically, keeps some people out. I have a big community of small cap PMs I've talked to over the years, and a lot of those teams are like a lead PM, maybe a co-PM, and then like 2 or 3 analysts, right? You often have a lot of teams of like 3 or 4, and often I've found over the years it's the lead PM who takes on REITs because they're a big part of the Russell 2000 benchmark, and no one else really feels like they have the expertise. So I do think the fact they're a little bit different, kind of puts them in the penalty box sometimes.
Well, as regards the other sectors that you were talking about, doesn't it depend where Washington turns its gaze next year? Because it seems like this year that was what moved in markets.
I think that's a fair question, and it's one thing we try to capture in the quarterly analyst outlook survey that we did. We also published that last week. It's a global survey, and when we carve out our U.S. analysts specifically, we do still see some concerns about policy risk on the healthcare front. We also see it for consumer staples, consumer discretionary. But I think the reality is that as we go through sector by sector, nothing is perfect. So we've flagged the policy issue on healthcare as a risk that we are monitoring, and we're not trying to dismiss it. But I will say, as I talk to U.S.-focused PMs, they're maybe a little bit less engaged on, I'm not going to do this because of policy risk. It's more of we can't predict a lot of the policy risk and we have to deal with it when it happens. And frankly, a lot of PMs I talked to over the last 6 months have said, if there are policy issues that emerge that cause disruption in a sector, we want to go in with a mindset of evaluating where the opportunities have emerged because of that short-term disruption.
I look at, as I was saying before, I look at the PEs on the GICS sectors of the S&P 500. Energy, I see to be the cheapest. And no matter how I change it up, I see utilities as pretty cheap too, trading for 20 times earnings, right? Compared to much bigger numbers for hyperscalers, for IT, for industrials, consumer discretionary. What do you see when you look at that?
So when we do our data, we basically take the historical constituents of the different GIC sectors. We do retroactively apply methodology changes. So whatever the current structure is now in terms of what goes where, we retroactively apply that. Our data goes back to '89. We do medians, multiples, we do Z-scores, and we look at both a relative PE, so the PE against the broader market, and then just the absolute PE, the PE against the history. And I'll tell you, when I do that work, industrials...
Laura, you're deep in it.
That's just what I do. Like, I'm a poli-sci major who's good at math, but like, we have some wonderful partners, you know, in terms of our technology partners who help us put all that together. But the, you know, and we also kick out, you know, we have rules to kick out outliers and that sort of stuff. But at any rate, I'm getting too nerdy. What we see when we run that analysis, so there's a grid, industrials is the worst offender, right? And if I think about industrials, I've been hearing for years, probably like 4 or 5 years now, there's some policy thing, there's some theme thing that is making the E understated. And all I know is, you know, themes come and go. And when we look at that very, very long history, it's an elevated sector. AI is one of the things that recently has, you know, kind of boosted expectations around the E. Utilities, I don't know the differences between my methodology and the Bloomberg methodology, but it is looking not as bad as industrials, but it is flagging a bit expensive. And
because of the AI.
You know, that's where I noticed, I think it was last summer, not summer 25, but maybe summer 24, where we started to hear about it as an AI beneficiary and the flows took off. And I have liked this sector in the past. We're neutral now. But we noticed that after you had gotten some of those inflows, after that AI theme had emerged, the sector, you know, started to become more expensive. So we've moved to the sidelines on that one.
What if the Fed stays on pause for some time?
So, you know, what's interesting, Vonnie, it's a great question. I will tell you, we talked a lot about that in my recent trip to Europe. What I care about from the Fed is sort of the general, you know, kind of number of rate cuts. But we actually did, and so we've said, you know, if we get 2 in the next year, even if we're on pause for a little bit, that's okay. And I'll just give you a backup of the model we put in our process for the first time this year. Is we went back to 1990. And we looked at Fed moves in a 12-month period, right? So just over the duration of that 12-month period, was the Fed, you know, moving the policy rate down? Was it moving up, or was it flat? And we looked at different ranges. So generally things like, you know, kind of 1 to 4 cuts and so on and so forth. And then the same thing on the hikes on the other side. But we did actually look at flat. The flat Fed is your best environment historically for the stock market. After that, your 2 best are the Fed hikes a little or cuts a little, 100 basis points or less. And as you kind of move to the tails on that graph, your overall equity market returns diminish and eventually turn negative. So one thing we've been talking a lot about in outlook season is we don't want the Fed to do a ton if you're looking at the historical playbook. A few more cuts, that's a great backdrop for stocks. If the Fed moves, you know, to sort of not doing anything, the historical playbook, of course we have to consider context, but the historical playbook actually says that's even a little bit better than the Fed just cutting a little bit.
So gridlock is good no matter where you are in Washington.
Well, that's definitely true on the midterm side.
Lori, so awesome having you with us all year. Really, it's been a pleasure. So thank you very much. I wish you a very Merry Christmas and hope to see you here on Open Interest on the other side of this holiday. Lori Calvasina there of RBC Capital Markets. Let's get a check of what's going on this Monday morning in the equity indexes. Right now, we're looking at gains of about 0.5% on the S&P 500. So 68.64 is the level there. Reminder, our closing high, if it matters, 69.01. Let's get a look at what's going on in terms of some of the single stock stories at this hour. And NVIDIA, Vonnie, obviously is the big mover that matters.
Of course, that report, the company has told Chinese clients it aims to ship its second most powerful AI chips to China by mid-February, helping that stock move.
Nelson Peltz's Trian Fund Management and General Catalyst, as we've been telling you, agreeing to buy asset manager Janus Henderson for about $7.4 billion. As a result, Janus is up 3.5%.
And Paramount sweetening its offer, surprise, surprise, for Warner Brothers, with Larry Ellison agreeing to personally guarantee $40.4 billion of the equity financing. And we're going to stay on this story now. We're joined by Bloomberg M&A reporter Matthew Monks. This is just fascinating, Matthew. I mean, another offer on the part of Larry Ellison. When does this actually get decided? Shareholders aren't going to vote till the middle of next year.
Yeah, not until the middle of next year. So look at this through the lens of we're still in the gamemanship kind of phase. We're kind of negotiating out in the open. So what did Larry Ellison do today? He basically said, hey, listen, I am the third richest man in the world. And by the way, I have this $40 billion to backstop this deal. It is real.
Which I think is hilarious because,
yes, exactly.
I mean, of course, if you don't have the money, get out of here anyway.
That's right. And if you go back to initially they said we've always backstopped this, right? I'm the third richest man in the world. It's in a revocable trust. Of course, we've backstopped thousands of deals. That's what they've said from the beginning. What's he saying now? Oh, it's an irrevocable trust. And, oh, by the way, I'm going to open up my books and you guys can actually see that I have the money and I'm going to prove it. Now, does this really change anything? We'll see. I mean, he was saying it from the beginning, and now he's basically just kind of validating that he does indeed have the money. He didn't raise the offer price.
Yeah.
So it's really, he's just saying, yes, the money is there. And if you see Redbird, when they went and did their interview this morning, they basically said, well, what this does is this kind of clears up some of the obfuscation around this deal, right? Like, the WB side is saying, oh, well, is the money real? Is it not real? They're finally saying, yes, it is real. We said it was real all along.
But if I'm a Warner Brothers shareholder, to your point, I want to see a sweetened offer. I mean, for real sweetened, like a higher price paid to me.
That's what it comes down to.
And when are we going to see that? I mean, I guess you're expecting probably both sides to start to ratchet up their offer.
I'm not going to speculate on who raises an offer when, right? But they are moving in that direction. They did raise the termination fee, right? There's a wide expectation that they are going to. I can't say whether they're going to or not. And this does indeed leave some more headroom for them to do so.
Sure, but at some point, one of them will decide this isn't worth it anymore, right? I mean, it has to be economically valuable to whoever buys it as well. It can't just be can't really just be a vanity project, can it?
No. I mean, listen, there's real value here. It's a once-in-a-generation asset. They're going to fight to the bitter end, I would suspect. Now, anyway, getting back to your main point, who raises when, I can't really say. But what we are really seeing is kind of cleaning up on the negotiations that should have happened, actually, months ago, but it's kind of still happening out in the open. And then also contrast this on the other side, what you see Netflix doing, right? So they came out and they refinanced their $59 billion bridge loan, or $25 billion of that. They're doing a very plain, vanilla thing, right? Refinancing a very large bridge loan. But the optics of that is saying, hey, listen, our money's locked down. It's all good. Whereas the Ellisons are out there saying, no, our bid's still real. So that's kind of the way I look at it.
By the way, there's normally on a deal that you work on, you're looking at the financials, right? Yes. You're looking at the money. You're also looking at the Washington aspect. That's right. But probably not as with as much intrigue as you are looking at the Washington aspect in this deal because of the closeness between Larry Ellison and the President of the United States. And I note that Bloomberg Law's Kate Ackley also has a piece out saying, look, it's not just about the White House. Like, you've also got to lobby Congress here.
Yes, that's right. Well, listen, if you guys want to tell me which direction regulators in Washington is going to go, good luck, right? Nobody really knows, and that's fair. But the financing issue, it is real, unfortunately, and we do see this in a lot of transactions. Like over this Bright House Financial, it was a small annuity deal. They were hung up on the financing for it. So this financing question, whether the money is real or not, it is a real thing that happens in M&A transactions all the time.
All right, can't wait to see who makes the next move and what that move will be. Would love to know what David Zaslav is thinking right now. That is Bloomberg's Matthew Monks. Coming up, lawmakers respond to the Epstein files release. We look at how the Trump administration's response could influence the midterms. This is Bloomberg Open Interest.
It's getting out of high interest. Look what's making headlines around the world. JP Morgan is exploring cryptocurrency trading for institutional clients, signaling a shift by the Wall Street giant. The move comes as U.S. regulators grow more crypto-friendly and client demand rises. And while plans are early, JP Morgan is weighing spot and derivatives trading, marking a fairly dramatic turn for the CEO, Jamie Dimon, who was once a vocal Bitcoin critic. Nelson Peltz's Trian Fund and General Catalyst are going to buy Janus Henderson for about $7.4 billion. Shareholders are going to get $49 a share in cash, topping an October bid. Trian, already a major owner, caps a 5-year activist campaign alongside partners including the Qatar Investment Authority. And Democrats are threatening legal action after the Justice Department missed a deadline to release the Jeffrey Epstein files. Lawmakers say the DOJ is violating a bipartisan law by slow-rolling, heavily redacted files, releasing some but not all of what it's got, calling it a cover-up. The department says more documents are coming, citing volume, victim protections, and court limits as part of the problem. The partial release has reignited political fallout ahead of the midterm elections. Vonnie?
Well, Matt, let's get some more insight now onto how the controversy could impact the midterms and also just the outlook in general for next year. Nathan Dean, senior government analyst for Bloomberg Intelligence, joins us now. So just first of all, give us your take on, everything that's going on Epstein related. Will it have an impact on midterms?
It will only have an impact on the midterms if we come back in 2026 and the Republicans are talking about it, because every day they're talking about the Epstein files is not a day that President Trump is talking about affordability. With his address to the nation last week, President Trump is beginning to recognize that affordability is really what's driving a lot of the conversation here and is driving a lot of the voters' mindsets. Look at Virginia, New Jersey, Miami, and New York City. So if we get into 2026 and these Epstein scandal, drama, political discord continues, that's obviously not going to be really good news for the White House. So again, we'll have to see what happens in 2026. But again, for these midterm elections, the Epstein files situation is something that's taking away the Republican message.
I got to ask, Nathan, from an outsider's perspective, up here in New York City, it looks like Speaker Mike Johnson and Pam Bondi and President Trump are doing everything they can to keep the Epstein files hidden from the American people. How do they spin that in the 2026 midterms? Why aren't they just releasing this information? What good does it do for them to hold it back?
So the mindset you have is probably the reason why Republicans voted overwhelmingly with Democrats to pass this legislation that essentially said, look, you have to release the Epstein files. And when you have redactions coming out and you have statements like there are investigations and we're taking back and we're doing this slowly in a way, yes, the DOJ most likely or could be doing that. But from a political perspective, it's not going to resolve the Republican angst over the Epstein files in 2026. You've seen from Representative Massey, obviously not a fan of the White House, but Representative Massey of Kentucky has already come out and said, look, I'm going to explore this idea of articles of impeachment against the Attorney General. Now, the articles of impeachment or Senator Schumer saying here's a resolution to try and hold the folks accountable, that's, again, just political messages to try and get the political opinion to change back to the point where the American populace wants this released. And so a lot of politics are being played here. From the market perspective, there's not all that much of an investing angle. But really, for every day they're talking about Epstein is not a day they're talking about affordability, and that's good for the Democrats.
Well, and just in terms of the midterms, Nathan, that's going to take up a lot of oxygen next year. What actually gets done legislatively in Washington, D.C., particularly as it pertains to markets?
So we're telling our clients that next year is not a year about legislation. I mean, even though you're hearing whispers of Reconciliation 2.0, this big bill similar to like the One Big Beautiful from 2025, we're somewhat bearish on that. The margins aren't really there. And look, if it was easy, they would have done it in the first package. 2026 is a year of deregulation because for the congressional perspective, every day that all 435 members of the House of Representatives is here in Washington is a day that their opponent is campaigning against them back in their districts. They don't want to be here. But the regulators, they live here. And so you are going to see more deregulation taking place next year, which is beneficial to crypto, banks, broadcasters. A lot of the deregulation sentiment that came with the Trump election back in 2024. Well, 2025 was a year about getting the chess pieces in place. 2026 is an implementation year. So by the end of the year, deregulation is going to have a dramatic impact.
2026 is a year in which at least 20 million Americans are going to be paying more for their health care coverage, right? Where are we in terms of the ACA subsidies?
So obviously Congress left. They're not here in Washington anymore. At the end of the month, these subsidies expire. Open enrollment is January 15th. That's when the open enrollment date ends. And so there is some thought that when Congress comes back in early January that maybe they'll be able to put something together. But from the Republican point of view, it's not so much more so about now whether you do subsidies or not. It's whether you have a replacement for Obamacare or not. I mentioned reconciliation earlier. This is a way that you can avoid the Senate filibuster and you can actually put forth legislation, which is how President Obama did Obamacare back in the day. There's talks, Senator Lindsey Graham has already said, look, I'm going to go for it. So you are going to anticipate hearing from the Republicans a new Obamacare replacement message. But like I said before, if it was easy, they would have already done it. And so there's going to be a lot of debate here. But again, because of the margins of the House of Representatives is so thin, more likely than not, I don't think anything really major gets done.
All right, Nathan, thanks so much for joining us. Nathan Dean there of Bloomberg Intelligence, walking us through some of the biggest issues in Washington, and there are a lot. Definitely follow his work on BI Go. Still ahead, we get to really another piece of this Washington story. From saunas to mattresses, Truemed helps people use their health savings accounts to buy a range of products. We'll talk to the CEO about their latest funding round next. This is Bloomberg Open Interest. Let's get a check on the stock market right now. The S&P 500 is gaining right now 32 points, about 0.5%, as you can see here from the move screen. Breadth is strong, 384 stocks to the upside, 118 stocks are falling. On the winning side of the ledger, NVIDIA adding the most points, right now up almost 1.5%, so good for 7.5 points. But you've got Tesla as well as Facebook, Oracle gaining today, Micron getting a little bit more after the earnings release that we saw last week. On the downside here, you've got some of the Mag 7 stocks falling. Apple and Microsoft are losers. And you've got Walmart and Eli Lilly down as well. So it's not just those mega cap tech stocks that are falling. Take a look at the breakdown of industry groups this morning in the early trade materials. One of the biggest winners. You've got energy, also a big winner, which we're going to talk about next, as well as financials. Let's look at year to date, Joe. Go ahead and drop down that menu and click into it. Here's what we've had, and we'll take a look at this tomorrow again. The comm services. These are the hyperscalers, up 31%. By far the biggest winner year to date, and followed closely by IT. So it's all about that AI rally. Coming up, though, we're going to talk about healthcare with the CEO of Truemed after it closes a $34 million funding round. Healthcare company Truemed announcing a new $34 million funding round led by Andreessen Horowitz. Truemed helps consumers use tax-advantaged savings accounts to buy a range of wellness products, including cold plunge pools, saunas, mattresses, and supplements. Joining us now is Justin Mares, the company's CEO, to talk about, I guess, Justin, first off, what are your plans with the money? Where are you going to invest it? And how much more funding do you need right now, or are you cash flow positive?
Yeah, we're not cash flow positive yet, but that's because we see a huge market opportunity here. For the first time, truly in my lifetime, certainly in the last couple decades, I think Americans are waking up to the idea that something in our healthcare system is fundamentally broken. And, Americans for the first time are talking about more than just drug pricing or the cost of healthcare, but they're talking about how do you fundamentally make Americans healthy? And I think that is our focus is, we have a traditional healthcare system that pays once people are sick. We're sort of asking the question, how do you incentivize people to invest in their health, to fix many of the chronic conditions that are decimating Americans at the root through effective lifestyle interventions? And so our plans with the funding are just, to invest more in marketing awareness, things like that.
And as I understand it, you hire Open Loop to have letters written. They basically hire people to write letters that would allow people buy machines, buy better food and so on with their health savings accounts money. Is that how it works?
So 21 years ago, HSA accounts were basically created so that individuals could better afford healthcare. And, for 21 years, the IRS has been explicit that, if you have a condition that you're working to treat, reverse, or prevent, a practitioner can basically decide to write you a letter of medical necessity. This has been happening for 20 plus years. We've basically just built modern technology that makes that process easier so that, your average person can access many of these life-saving lifestyle root cause interventions.
Justin, we were talking about this in the editorial meeting this morning. It makes sense, obviously. I'd rather spend money on preventative measures than have to spend money on my health after I get sick or diseased. But what are the guarantees that the IRS is going to accept this stuff? Because if I go and buy, some kind of weight lifting machine equipment or a special mattress to help me sleep better and improve my health, I still need to be sure that the IRS is going to approve my use of the HSA on that.
Yeah, so it's a good question. So individuals, again, like I said, have been using these accounts for 2+ decades. And the whole question I think that we have to be asking is, what is an effective treatment for many of the chronic conditions that are decimating Americans? 90% of our healthcare spending is going towards chronic conditions that are related to lifestyle in some way, shape, or form. And so I think that the question we have to be asking is, like, clinically, what is the best intervention for someone working to treat, reverse, or prevent obesity? Like, yes, it might be a GLP-1 for certain people, but for people that are at risk or something like that, it may be an exercise intervention. It may be a sleep intervention or things like this. And there are thousands of studies that show that these effective lifestyle interventions are often better interventions than putting someone on a statin or a GLP-1 for the rest of their lives.
Justin, that part's understood. I'm just saying, like, if I buy a $1,000 piece of equipment and then I get a letter from you justifying that, and I use that letter to okay the spending to come out of my HSA account, what are the chances that the IRS says, no way, Jose, a doctor's letter is not good enough?
Yeah, it's good. So as long as the letter satisfies the condition, it's written by a practitioner within their scope of practice, it follows state telemedicine laws, it is up to the individual basically to be telling the truth when they talk about these things that they're working to treat, reverse, or prevent. It's up to the third-party administrator to make sure that that is appropriate within someone's plan. But frankly, as long as those two conditions are satisfied, the IRS has been very explicit that things like prevention of obesity count, that exercise equipment and fitness regimens count, all assuming that you have the risk factors that, around treating, reversing, or preventing chronic conditions, which sadly, 93% of Americans do.
So your webpage is almost like a storefront. You even have foodstuffs up there, everything from steaks to broth, which I believe is a company that you had also founded as well at one point. How do you have HSA dollars available for that? How do you make that IRS compliant? The IRS has sent out alerts about your business model, for example. Will they continue to do that? Does that concern you for your clients?
Yeah, so the IRS has been explicit that it is dependent on the individual. And so the IRS has sent out a notice saying that basically things like exercise, supplements, diet, they don't count for general health, which is totally true. What I think has changed is 20 years ago, the average American was not at risk of chronic disease. We didn't have 90% of our healthcare spend 20 years ago going towards managing the symptoms of chronic conditions. And so I think, again, the thing that is changing is today the average American is sick. We have an almost 80% overweight obesity rate. Chronic disease markers are 93% of them have at least one metabolic marker of chronic disease. And I think that the thing to think about is, like, for a specific individual that has the risk factors and wants to treat, reverse, or prevent a chronic condition, is something like a medically tailored meal, an exercise regimen, things like this, are they clinically effective interventions? And does a doctor recommend them for the individual to treat a certain condition at the root cause? And if the answer is yes, it is up to that individual and the practitioner to determine that, as well as the plan administrator.
Justin, your former partner, your founding partner, Callie Means, has left the company, left TrueMed, and now works for RFK Jr. at the HHS. His sister has been nominated for Surgeon General of the United States of America by the Trump administration. How should investors understand your relationship with, the HHS and the administration?
Sure. So we started this company during the Biden administration, and my co-founder left and divested when politics became a distraction. Frankly, we think that politics is distracting, and health is one of the topics that should be the most bipartisan issue, period. Health should not be political, and we think that everyone should be using these tax advantage accounts that were started 20 years ago to invest in treating, reversing, and preventing many of the chronic conditions that is decimating Americans' health today.
All right, Justin, thank you so much. That is TrueMed CEO Justin Mares. Let's get a check now on markets as we head into the second full hour, I should say, of trading. So we have major indices higher, as you can see. We're off our highs, though. The S&P 500 up about 1/3%. The Nasdaq 100 just 1/4% higher now. Gold is just running away with things today, and Bitcoin was above $90,000 a coin, now back just above $89,000 a coin. So there's actually quite a lot of movement in this market today. I noticed that quantum stocks are doing extraordinarily well.
Yeah, you got to see movement on lighter trading days, right? And I think we can expect volumes. I'm looking right now at average volume at 14% lower on the Dow, 7.3% lower, and we're just into the session. Let's get a look at some of the stocks trading in the early session. A group of private equity firms led by Permira and Warburg Pincus have agreed to buy Clearwater Analytics for more than $8 billion, and as a result, Clearwater is up 8%.
Stanley Black & Decker agreeing to sell its aerospace manufacturing business to Howmet Aerospace for $1.8 billion in cash. It's the best performer in the S&P right now.
And shares of gold and silver miners rising after the prices of both of those precious metals, as Vonnie mentioned, hit fresh highs. Newmont, Barrick, and Core Mining all doing well in today's session.
And sticking with commodities, coming up, energy opportunity for those who wait. Why some unloved energy stocks may have some better luck next year. This is Bloomberg Open Interest. Despite tough forecasts for oil, many energy analysts are saying extreme bearishness will give way to a rally for those able to wait. Joining us now is Bloomberg Equities reporter Monique Malima. So Monique, explain to us what's to come. Why should we be patient?
Hi, yes, thanks for having me. So like you mentioned, some of the analysts are saying that maybe this has gone too far in terms of the bearishness. Crude oil prices have been really pressured this year on concerns of an oversupply. And well, the consensus is generally that there is going to be that potential glut of crude coming in the first half of next year. Analysts really see opportunity for a rebound after that. They think that these stocks, which have been declining in line with oil prices, that maybe there's still more opportunities to come. Some are saying even maybe the oversupply won't be as bad as people expected. And even if it does come, then producers are likely to reduce how much oil they're producing, which will then help prices to rise again next year. So they think there's really a lot of opportunities that we're going to see those rebounds back in these energy prices. And we've seen so much bearishness. Right now, the XLE, which is the energy ETF, it's being shorted the most since 2020, which was when obviously there was such a decrease in demand out of COVID-19. And we're not seeing the same level of decrease in demand right now. So they think there's even an opportunity for a short squeeze there.
Monique, how does the AI trade play into this? I mean, it's not the nuclear energy producers you're focused on. You're looking at mostly the oil and gas producers, right, in the S&P 500 energy index. But data centers are going to be using a lot of gas-driven energy as well. I mean, what's the AI trade doing to these stocks? Because it's amazing to see how cheap they are.
Yes, so like you mentioned, the data centers are using a lot of energy. Right now, most of them are still using gas for their data center power. Some are hoping to transition over to renewables. But for the time being, a lot of these gas companies have been able to benefit from this AI trade. And that's something that we've seen from analysts say as well, that in terms of the energy space, right now, some of the gas producers are better situated compared to the oil producers because they have this new demand for so much power happening all at one time. So there's going to be new opportunities for there as well. And we have seen a bit of a boost for some of them off of this. But like you mentioned, these stocks are still trading quite low. They're expected to be down this year. So there is those opportunities there as well for growth.
And Monique, obviously it depends on the administration's stance. I mean, it's not all energy stocks are going to do well, right? I mean, clearly wind stocks are likely not to do well.
Yes, so we saw today that the administration suspended some of the licenses for some wind providers offshore in the U.S., and that's been really weighing on the wind stocks today. But this is something we've seen consistently from the administration. They haven't been the most positive on wind. Well, they are very positive on energy. You know, the administration has said, you know, drill, baby, drill. They want to see more energy production. That doesn't necessarily fare always well for some of these energy providers because more production can also lead to that oversupply. But again, with their support of AI, of technology, there's going to be more demand for this energy going forward as well.
All right, Monique, great to get your take and fantastic reporting. Bloomberg's Monique Mulima, who wrote the story, Unloved Energy Stocks Set for 2026 Rebound Despite Oil Forecast. Check it out on the Bloomberg Terminal or on Bloomberg.com. Coming up, tariffs putting a damper on the champagne industry. We speak to Marvina Robinson, Stuyvesant Champagne founder and CEO, next ahead of this champagne season. This is Bloomberg Open Interest. Christmas staple in the Miller household is champagne. But caught in the middle of the tariff battle, trade policy has had a direct impact on founder-led brands for that spirit. Let's get a lay of the land with Marvina Robinson, Stuyvesant Champagne CEO and founder. And it is fantastic to have you here on set.
Thank you so much
for joining us. When I grew up, you know, the kids would start opening presents and the parents would start popping champagne bottles. Mm-hmm. Obviously, New Year's Eve also is probably the most famous champagne holiday. What does it feel like right now in terms of demand?
Well, we do see a decrease in demand with our friendly tariffs that are not so friendly. But, you know, some consumers are prevailing and still shopping. But we did see a dip in our sales for this holiday season. And I, too, like yourself, now that I'm a grown adult, on Christmas, I do pop champagne.
Talk to us about Stuyvesant. What kind of range of prices do you have, and have you had to move those prices higher because of tariffs?
So yes, we did have to make the difficult decision to raise our prices. So currently our prices now start at 64, ranging all the way up to 130. We did have to decrease the volume for half bottles because the pricing didn't make sense with the tariffs added. So we did decrease the volumes for production of 375 milliliters this year.
Tell us a little bit about your origin story. How did you get involved in the champagne industry? I think of, you know, the French, obviously it's got to be out of a certain region. What drove you to do champagne rather than some other alcoholic beverage?
Well, so I worked on Wall Street for 20 years, and studying champagne was my hobby, right? Me and my friends, we were younger, coming home from college at legal age. We would come home, catch up, and we would split a bottle of champagne. We would all chip in and buy a bottle of champagne. And it's just something I've always been drawn to. And I would always wonder, like, why is some sparkling are $12 versus $20, and then you have something that starts at $50, $60 when I was younger. So I started doing a little bit of deep research and realized that there's a whole difference between champagne, cava, or prosecco. And I was just drawn to champagne, and I started studying, going back and forth to champagne, and I just truly fell in love with it. And then for me, I wanted to share this story of champagne. I was studying more grower champagne. I would import them over to the States. And during that time, you know, another good friend of ours, COVID came about, and I wanted to open up a small champagne bar and have these different small growers there, and Stuyvesant be the house brand. And I had to pivot, and Stuyvesant became the business, and I just started to grow the business officially.
So now that you are dealing with tariffs and, you know, increased costs, how are you passing that on to the consumer? How much are you, raising price? How much are you eating in your own margins?
I have eaten in on my margins. The first 3 to 4 months of tariffs, I didn't pass anything on to my customers, so I ate it 100%. So now we pass about like 10 to 12%, depending on what the price range or our most popular. One of our most popular cuvées, we didn't raise it much because we know that's a fan favorite, but some of them we just spaced it out within the pricing. And then for our half bottles, we just reduced production and kept them at the same price so that consumers can still use that, because during the holidays, gifting, half bottles are very popular.
So what is your biggest driver of sales? I mean, are you looking at a specific kind of marketing? Are you partnering up with celebrities? Are you looking to be in specific bars or restaurants? What's your aim?
So we have different sources of our projected clients, right? We have retail where we're sold at several stores. We have our direct-to-consumers, which can shop directly off our website. We do have some restaurants that carry our brand. And going forward, I would love to continue evolving all 3 branches, because you think about, you get a different type of consumer in each one of those options.
Look, it's obviously a category that's dominated by some very big names that we all know, right? How do you compete with that kind of brand recognition, and how do you get your brand out there?
You know what? I don't compete. I just know Stuyvesant. Our customers know our brand. You know, they continue to help us grow organically where they refer us. You know, social media is big for us, where they tag us. I'm very hands-on in the brand. Like most of the time, we have a tasting room in Brooklyn, New York, in the Brooklyn Navy Yard. If you come into the tasting room, 90% of the time, I'm there and I'll walk you through your tasting. I also am a big believer, if we sip it, let's learn about it. So I'm also about educating champagne. So anytime we do postings or we have events in our space, I try to give a little bit more background.
We keep hearing that the younger generation is drinking less alcohol, that maybe they're turning to other substances to have a little fun or whatever. Are you seeing that in your business? Is it primarily older people that are buying?
No, it is definitely legal age. It is definitely a mix of everything. I feel like consumers of all ages, they're all curious about champagne, but sometimes people think it's only for, you know, to celebrate, and it's not. Champagne can be consumed with any meal. My favorite pairing is fried chicken and champagne. That's our signature pairing when we do any of our events. I think that people are just curious, and if you're, sometimes a drinker, you want to know more about it, you try it, you make a decision if you want to keep coming back. Try non-alcoholic, but most people, when they taste Stuyvesant, they come back.
Yeah.
I actually had a non-alcoholic sparkling Riesling over the weekend,
that?
which was actually quite good. But obviously, I'd rather have, a glass of champagne. What do you expect for next year? How are these tariffs, which don't look set to change, going to affect your business, and how will you be able to grow beyond them?
Well, I'm waiting to hear what the Supreme Court decision is going to be, because that will...
That's a very good point, actually.
Yes,
yeah.
I'm waiting to hear that, because we actually have a pending case there, because we're represented by NCLA. So I'm hoping to hear something positive about that. If the tariffs do not change, it's just about finding new ways of creating additional consumers for the business, explaining to our customers, because we were very open. I was very open with our customers, like what's going on with the tariffs, with the price increase. We haven't done a big $10, $12 jump, and we won't do that. So I might have to just continue to eat on some of the margins, because, we're a small business, and I want our business to continue to grow, and our clients love us. So I want to make sure that we retain them and make sure we remain price friendly for all to enjoy.
Where do you import or export mostly to and from?
So we import directly from France. Our vineyard is in Epernay, and we import directly into the States. So one of the things that we are going to do is we're starting to explore more outside of the United States, so we can get some more of other countries to carry Stuyvesant.
We got to ask you one last question for our Business Week colleagues. We want to ask you, what is the best party that you've been to, and tell us a little about it.
Oh, the best party I've been to in my life?
Yes.
I would think maybe in 2025,
Okay, so yes, there was actually a champagne concert in June I recently went to in Champagne, and it was probably one of the best parties I've been to.
Why so?
It was just fun to be amazing. Jermaine Stone, he does this amazing party called the Wolf of Wine, and it was just a fun environment. Everybody there was all about champagne. It was a concert. Everybody was pouring, popping bottles. It was amazing. So that was actually my best party of 2025.
Okay. Looking forward to lots more in 2026.
Yeah, me too. Hope you join us again, Marvina. Thank you so much.
Thank you very much
for your time.
Thank you.
Marvina Robinson there, a Stuyvesant Champagne. Let's get a check right now on what's going on in the markets. Investors hoping to pop some bottles this holiday season. S&P 500 rising back towards an all-time closing record right now at 68.67. The record at 69.01. The Nasdaq right now at 0.4%, 25,450. Coming up on tomorrow's program, Joanne Feeney of Advisors Capital Management joins us, as well as Shana Sissel of Van Ryan Capital Management, and the Points Guy, founder Brian Kelly, will tell us how we can get a cheaper ticket to Champagne and join Marvina at the party again next year. This is Bloomberg Open Interest.